This is Mission Possible Inclusive Capitalism, the podcast show that fixes economic inequality, economically empowers Main Street, and has a little fun along the way. Hello, I'm Catherine, and welcome to today's episode. The ultimate goal of free market capitalism is a corporation's service to its customers and broader society. That's a quote by Wall Street's most important pioneer of the last 50 or so years, John C. Bogle, whom Warren Buffett has called his hero. And this quote comes from Jack's book, Clash of the Cultures, Investing versus Speculation, which was the focus of my interview with him. Today's episode is a very special one for lots of reasons. Jack Bogle was a true American classic, and perhaps unrivaled as a warrior for Main Street's investors, savers, and pension fund beneficiaries. I say was because Jack sadly since passed earlier this year, so it was an immense privilege to have been able to tape this interview with someone who has been such a profound inspiration for so many people, and for me in so many ways, including for the critical importance of the mutual ownership model, whereby the company is owned by its customers, not shareholders. And it is this mutual ownership model that has been critical to me for this platform for Main Street, advocating for Main Street's best interests and stake in capitalism, and making Wall Street, via its public equity function, more effectively serve Main Street's economic interests instead of its own. Jack could have been a billionaire, but instead he chose to create wealth for Main Street's investors instead of himself. By the way, when we talk about investors here, Jack is referring to the 55% of American households who are shareholders either directly or indirectly via their pensions, 401ks, and other saving products, etc. You might not think of yourself as an investor because you might not be managing or investing your money, but it is your money, and so you are the investor. Now, the term can be used rather ambiguously to refer to either the person who's managing the money or the person who owns the money. But here, generally speaking, when we talk about investor, we're referring to you, Main Street. Once or twice, however, we do also use it to refer to the managers on Wall Street of your money. Remember, Wall Street is not using its own money, it's using your money, Main Street's money. And too much of Main Street's wealth, via your pensions and savings, is abused by Wall Street via extortionate fees and diabolical investment performance, and a failure to be effective stewards of Main Street's capital, which means nurturing sustainable long-term growth and thereby investment returns. As Warren Buffett recently said, Jack Bogle has probably done more for Main Street's investors than anyone in the country. And I quote, "When Jack started, very few people, certainly Wall Street, did not applaud him. He was the subject of some derision, and yet Jack, at a minimum, has saved in the pockets of investors. He's put tens and tens and tens of billions into their pockets. He helped millions of Main Street's investors realize far better returns on their savings than they otherwise would have earned. He is a hero to them and to me," said Buffett. So not only was Jack a true American classic, he was also, I dare say, a true American badass. At the age of 44, Jack was apparently told by his doctor that because of his rather dodgy heart, he had just weeks to live, and so he should go off to the seaside and spend the rest of his days there. Jack, however, decided to heck with that, because he had a mission to fulfill, and his mission was to serve Main Street and to save regular investors, savers, pension fund beneficiaries from being so atrociously ripped off by Wall Street. And so instead of heading off to the beach as his doctor prescribed, he did something that no one else had done before. He launched the world's first ever index fund. That's essentially low-cost investing funds for Main Street savers and investors without the gargantuan rip-off Wall Street fees, basically. At first, it was a complete disaster, and Wall Street laughed their heads off at him and cutely called his fund Bogle's Folly. And what did Jack do? Well, as he advised me, what makes the difference between success and failure is if you are truly committed to your mission to serve society and stay the course. And indeed he did, and what was initially a failure was gradually built by him into a $5 trillion company, Vanguard, which is today the largest mutual fund company in the world. Jack worked unstoppingly to try to instill integrity, service, honour and duty at the heart of what Wall Street does, and building a $5 trillion company owned not by shareholders but its Main Street customers is a rather impressive measure of his success. But another aspect of Jack's incredible character is that he chose not to become a billionaire as he would otherwise have been. Let me explain. By pioneering an ownership model whereby the company would be owned by its customers, Main Street savers and investors, instead of having outside shareholders, he broke the mold. This was critical to his mission of serving Main Street because it meant that customers' best interests would always be put first and would never be compromised because of shareholders. But in choosing this structure of ownership, he essentially gave away to his customers the ownership of the company he built, and thereby he was giving away to his customers immense wealth that he could otherwise have kept for himself. Compare this to Larry Fink and his colleagues when they set up their company 13 years later in 1988. They later sold their company into shareholders' hands, thereby becoming billionaires, even though their company and Jack's company, Vanguard, are similar in size, holding the number 1 and number 2 spots globally. And that is character. That is class. And there's an utter absence of that on Wall Street. In an interview with Alison Smith on NPR in 2008, he quoted something on Albert Einstein's wall. There are some things that count that can't be counted, and some things that can be counted that don't count. Talking about his book, Enough, True Measures of Money, Business and Life, Jack said, "We have a counting society, and we rely on numbers to give us facts that are really not facts." He was talking not only of what he called the breathtaking amount of financial engineering going on with company and Wall Street reporting, etc., but also in a wider context. And I quote, "We think we can count everything that's important, but we can't. You can't measure character. You can't measure integrity. You can't measure moral conduct. You can't measure love. And these are the things that are really important in our lives and our society." He also shared a story about the authors Kurt Vonnegut and Joseph Heller, who were talking at a party hosted by a billionaire hedge fund manager, and Vonnegut says to Heller, "You know, this billionaire makes more money in one day than you made in your whole lifetime from your novel Catch-22. And Heller responds, "Yes, but I have something he will never have. Enough." So in my chat with Jack, we're focusing on some of the key themes from his book, Clash of the Cultures, Investing versus Speculation, including the following. Number 1, how Wall Street is failing to do its job by gambling and speculating with Main Street's money instead of investing it for long-term sustainable growth and helping companies build strong, long-term growth prospects via effective stewardship. Number 2, how Wall Street is ripping off Main Street by failing to do its job while charging eye-watering rip-off fees and benefiting from huge economies of scale and thus enormous operating profit margins compared to virtually every other sector in the economy. And number 3, how this significantly harms America's long-term economic growth, American corporations' long-term profit growth, as well as long-term investment returns for Main Street savers, investors, and pension fund beneficiaries. Jack, you've written that trading with itself is mostly what Wall Street does, which enriches only itself and fails to serve its clients, Main Street, in any way. You talk about all this paper swapping, buying and selling bits of paper. How big is this rather pointless paper swapping?
Well, last year, take that as a good example, the trading on Wall Street amounted to about $70 trillion. And the amount of new capital that was raised by Wall Street amounted to around $250 billion. So we're talking about trading being 99.6% of what Wall Street does and providing new capital to business about 0.4%. It's a huge difference. Wall Street is a casino and not much of a source of capital.
But what's the problem with Wall Street being a casino? Surely this must somehow benefit Main Street's savers and pension fund beneficiaries in some way, otherwise it wouldn't happen. Aren't they getting great investment performance from this high-whiz trading at the casino?
Well, the answer to that is unequivocally no. And that's not an opinion, that's a mathematical fact. Because when somebody is trading, there's a buyer and there's a seller. And the buyer and seller, one wins and one loses. Or the other way around, one loses and one wins. So there's no value created out of that at all. It's just a shifting of where the returns on that particular investment appear. So there is one category, one sector that makes money when we do all this trading with one another, and that would be Wall Street itself. Because in the middle there is our commissions, underwriting commissions, brokerage commissions, and extended further investment management fees, transaction costs, sales loads, all those things that get in the way of investors capturing their fair share of market returns.
So who's paying for all of this paper swapping?
You are. You, the investor, are. Main Street is paying, and Wall Street is getting the benefit of it. We can measure all this in dollars and cents.
You've written that financial engineering is essentially rent-seeking in nature. What does this mean, and how is this different to value creation?
Well, financial engineering is playing games, for the want of a better expression, in the stock market. And there are firms that do this. They believe they own the secret, whatever that may be. But I've always felt that the secret is that there is no secret. The way Wall Street works, it's a closed system. Sometimes the buyers of X win, and sometimes the sellers win. Nobody knows that. So Wall Street, when we use the term rent-seeking, but it's anyone who benefits by being in a transaction who contributes nothing to the value of that transaction. That's the man in the middle. He always gets paid, whether he doesn't really care whether the buyer wins or the seller wins, but he makes money by subtracting value from the nature of the transaction. So middlemen are basically rent seekers and trying to earn money without putting any up the capital on either side.
So you talk about the issue of short-term casino speculation, which is rent-seeking and wealth appropriating, and how this is replacing long-term investment, which is how real economic value is created. But hasn't this always been the case?
Well, of course, there has always been long-term investment and short-term speculation. What's different in the current era is the relationship between the two has changed, I think, radically. Take the example of the mutual fund industry. When I came into this business in 1951, typical turnover, amount of change in a mutual fund portfolio, was around 22%. It now runs in the 80% range. That's 4 times as much turnover, and therefore not quite 4 times as much cost because commission rates are down, but very large cost you incur when you're trading. So to the extent you're going to avoid trading, own an investment for a lifetime, you're going to be greatly, greatly advantaged.
Economist J.M. Keynes warned that the problem of this speculation and gambling is that it crowds out real investment, which is so critical to economic growth. You argued that the stock market is a huge distraction from proper investing. What do you mean?
Okay, let me make this simple. Where are returns created? They are not created in Wall Street. They are created by American business. And American business sells goods and provides services. They become more and more efficient, more and more competitive, and more innovative, and within the firms, more and more entrepreneurial. So they're fighting to grow, and they do grow, pretty much all of them together. They grow along with our gross domestic product, or GDP. So that's where value is created. America's corporations earn money, pay that money out in dividends, some of it, retain the rest, and use those retained earnings to improve the business, to undertake new ventures, to improve quality, all those things of that nature. That's where returns come from. A simple way of looking at it is the returns created by corporate America represent the dividend yield when you buy in to the stock market in total, and what additional earnings growth follows that. So if the dividend yield were 3% and the earnings growth were 6%, that'd be a 9% return on intrinsic value, we can call it that. And that's all the returns you get. But in cycles in the market, we have the entry of speculative return. And speculative return is generated or ungenerated by the change in the valuation of a stock, easily measured by the price-earnings multiple. If you buy a stock at 10 times its earnings and it goes to 20 times its earnings over a decade, you've made an extra 7% a year. That's probably larger than the investment return you get. But then the reverse happens. It goes from 20 times earnings back to 10 times, and you would lose 7%. So in the long run, 100% of the return on stocks is created by the returns of businesses and not by the returns of speculators.
What is universally accepted as Wall Street's mission has been aborted, you wrote. Similarly, Nobel laureate economist James Tobin has asserted that the financial services industry creates no real economic value for society. And Lord Adair, the former chair of the Financial Services Authority, has also said that most of what Wall Street does is, and I quote, socially useless activity. So what is Wall Street supposed to be doing instead, then?
I think the answer to that is less. We don't need all that trading. We do need the capital formation. All that trading costs investors a lot of money. Wall Street is simply consuming too much of the return that our corporations are providing through that intrinsic value, those dividends and earnings. So to take a lot of activity out of the system is a way of increasing the share of those business returns that goes to Main Street and reducing the share that goes to Wall Street.
So you wrote, costs are the biggest predictor of returns. Tell us about these costs.
And that's actually a little bit different from the previous subject we were talking about. that sentence that costs are the biggest predictor of mutual fund returns, the returns earned by investment managers. So if you have two managers that earn 10% on your money per year, very high for what we'd expect today, and you had to pay 2% for that cost, you'd earn 8%. If you only had to pay a half of 1%, you would earn 9.5%. And I don't pick that example at random. This is about what the situation would look like with an index fund. An index fund is a fund that owns the stock market, owns all those corporations I mentioned earlier, and holds them forever. Yes, they change a little bit over time, but not in an alarming way. The largest 500 stocks are quite a stable group, and they're over probably 75% or 80% of the total value of the market. So we need less deductions from the system. It's as simple as that. Now, when you look at mutual funds, you look at the managers. Obviously, a manager who's charging 2% a year is going to have to earn 2% a year more than the manager that's charging 1% a year, more than the manager that's charging 1% a year, and a lot more than the non-manager, that would be the index fund, than the index fund that is charging you 0.05% a year. The difference over time is day and night.
So investment management firms' expenses have risen massively, and yet they're still massively profitable. In other words, they're passing on these costs entirely to the clients. Isn't this just the cost of being in this business?
All this is at the expense of clients. Management returns are paid by the clients. When you buy a mutual fund, for example, and you pay 1% a year, that's a little bit below the industry norm. About a half of 1% of that 1%, half of the total, is profits to the manager, and probably a tenth is the actual cost of management, and the other 4/10 is the cost of marketing and the cost of administration. So you're paying a lot for what you get, and particularly you're way overpaying for the investment management component with all these superfluous costs in marketing and administration, which can probably be done better than we do it today.
Let's move on to the impact that all this pointless, expensive casino activity by Wall Street has on Main Street and the real economy. Capitalism can't flourish like this, you wrote. But from the perspective of Main Street savers and pension fund beneficiaries across the country, why is short-termism so bad?
Well, it has two aspects. First, short-termism is expensive. Trading stocks is expensive. When you buy a stock and sell it and come back and buy another one, you pay a selling commission, and then you pay a buying commission. And when you sell that, you pay another selling commission. Trading is expensive, and the more you trade, the more your costs go up. So trading is antithetical to the earnings of the optimal returns. Trading is also bad for another reason. It gets our managers to focus on short-term events and short-term performance, and pressing companies, the companies whose shares are in their investment portfolios, to operate the company on a short-term basis. And I think it's universally agreed among economists and among businessmen that if you can focus on the long term in your corporate strategy, you're going to do better than changing the short term focus time and time again. So it's a question of short term things come and go, and the basic strategy of the corporation is going to work best if implemented over the long term. Because there are bumps along the way, and every time you get a bump, you can't do much about it. But the marketplace has to understand that that's part of running corporations. Business growth is not a straight line. So it affects business, short-termism, and it affects investor returns.
And this short-termism also severely hampers companies being able to invest properly in their long-term, organic, sustainable growth, doesn't it?
Well, what happens is companies are too much run for the short term when investments can take even longer, but a number of years to season and realize their potential. And it puts big pressure on corporations to make investments that have prompt returns rather than looking at things that have greater potential out in the future. Anything that takes you in a short-term focus, I run a business for years and years and years, and anything that takes you away from focusing on the growth over a long period of time is just not the right thing to do. It's right to get the long-term strategy correct and wrong to be managing around short-term strategy where, for example, if your revenues go down, you cut your research and development. That is a very foolish thing in almost every case to do.
In your book, you wrote that our nation's retirement system is fundamentally speculative and a serious train wreck with severe economic consequences. Can you explain?
Well, our nation's retirement system has basically three legs, three aspects. One is Social Security, and we now know that this is going to be totally underfunded by 2030 if we do nothing, and the payments that you get today will have to stop. I don't think that will be allowed to happen, so we have to increase, and it's speculative as to how much we have to do and whether we can do it. Speculation is what will happen. But we have to raise the minimum wage base. We have to make a better and fairer cost of living adjustment, which will reduce payments. I think we have to consider selectively increasing the retirement age. And I think we have to think about increasing the Social Security wage base. If you did these things, all would be well. The second leg is a defined benefit plan, the pension plan. And these are gradually vanishing for corporations and actually flourishing still for state and local governments. What's speculative about them is they are planning on higher returns than they would earn or possibly can earn today. They're underfunded by about 35%, and even if they were to achieve their return, the return they're planning on of 7.5%, they would still have a problem paying all their pension bills in the long run. And they're not going to earn anything like 7%. But it keeps the corporations from having to put more money in if you use very high future return assumptions, and that will collapse sooner or later. State and local governments are kind of bound because they have a pledge to their employees to pay these high pension benefits that they've fallen into, and they cannot raise taxes to balance the books because presumably the citizens of their communities will not approve that. So both of these areas of pension, private and public, are in trouble. And finally, we have, by far the most fastest growing, probably comes to something like $10 trillion, and that is defined contribution plans. And that includes primarily the so-called 401k plan that employees for corporations rely on, putting money away, and also the individual retirement account or a Roth IRA. The problem is in that system, the defined contribution plan system, people are expecting too much, and people are paying too much in the way of cost. Kind of the same scenario all over again. So they're speculating on earning higher returns than are possible in the future, and their managers are speculating on producing returns that will earn those higher returns, but they won't and can't.
Let's talk about hedge funds. As you point out, they have abysmal performance, net of fees. And the failure rate, the number of funds having to be closed down, is an extraordinarily high 20% each year. And yet their ads boast about how great their performance is because they only publish a couple of their funds out of a broad range of their total funds. In other words, they're just picking the best performers and forgetting about all the rest. It's a pretty abysmal state of affairs, isn't it?
First, it's a very diverse industry, and a certain hedge fund may have excellent returns for a given year and then terrible returns the next year, but other hedge funds may have terrible returns and then better returns the next year. The difference between hedge fund A and hedge fund B is huge, and so if you're an investor, you have a big selection risk, which one to pick. But all of them have one thing in common: extremely high fees. They take 20% of the profits and charge you 2% a year. That's just plain too much to allow you to make any money in the long run, other than very interim periods. So hedge funds are not going to do well. And as was said once, hedge funds are not an investment strategy. They are a compensation strategy. So beware of hedge funds. Beware of the selection risk. Beware of the failure risk. Beware of the cost differential, very, very high. And I'd say and tax inefficiency. In some cases, heavy leverage, which makes them quite risky.
So our state pension funds and teachers' pension funds, etc., really shouldn't be using Main Street's money to invest in these hedge funds. But it's not just hedge funds, it's mutual funds too. Famed investor David Swensen agrees with you. He talks about, and I quote, the fundamental failure of the mutual fund industry.
Yeah, the fundamental failure in the mutual fund industry, and I quote David here, he's the manager of the Yale Endowment Fund and been the most successful investor in America. The colossal failure, is his quote, of the mutual fund industry results from its systematic exploitation of individual investors as funds extract enormous sums from investors in exchange for providing a shocking disservice, that would be lower returns. And the end adds these rather harsh words: thievery, even when dressed in the cloak of SEC-approved governance, remains thievery, as the powerful financial services industry exploits vulnerable individual investors. Now, those are strong words, but when challenged by the Wall Street Journal that they were, in the journal's word, harsh, Mr. Swensen replied, "The evidence is there." And he's right.
You emphasize the importance of stewardship capitalism, arguing that this is how Wall Street investment managers should be helping companies to create long-term economic value, supporting companies in focusing on long-term economic growth via investing in long-term innovation, investing in workers as long-run productivity growth drivers, and in long-term profit growth. But they don't because they're short-term stock renters, not long-term stock owners. But Wall Street's institutional investment managers would argue that they are already very effective stewards and engage with company executive teams, having one-on-one meetings every day with CEOs and CFOs of America's publicly listed companies, advising them on corporate strategy, etc. So are you wrong or are they wrong?
Well, I believe these Wall Streeters who are telling you they're having interchanges with companies far more than I do now if they would just list the names of the companies, the substance of their conversation, and the outcome, if any, what the corporation agreed to do at the behest of the stockholders. Absent that, what can I say? You need hard evidence to defend your position, and these money managers do not do that. They do not give you hard evidence.
You wrote that workers are paying the price of the failure of Wall Street's institutional investors to be effective stewards of Main Street's capital. Please explain.
CEOs of companies are paid to make earnings grow, even in the short term. And one way to do that is to be really tough on your workforce. Pay them less, fire them. It used to be called downsizing, but now, ever in the American spirit, it's called right-sizing. The people who have done the work, given their lives to the company, either don't get the compensation they're entitled to, or get fired or replaced, or get packages, the word for an exit package from a company. So it's not good. All this pressure on earnings means the company has to start cutting out muscle from its ability to compete. And in the long run, it'd be fine if it were only fat, but it's muscle, and that's going to hurt the performance of the corporation because it's not going to do as well in the future in terms of growth.
So who controls these Wall Street institutional investment managers? I mean, ultimately, this money which they're investing is Main Street's money. Doesn't Main Street have some say in what Wall Street's institutional investment managers are doing with their money?
Well, of course, the owners of mutual funds, for example, control the fund, but they're diverse, diffuse, largely medium. Maybe the average investment in the mutual fund is something like $10,000. So individually, they have almost no power at all. They don't seem to care much about these issues. If they cared, were there a big uprising of shareholders saying, we want you to be stronger, it would happen. Managers, on the other hand, many of them tend to look at corporate governance as kind of not only a distraction from the work they're trying to do, but a costly distraction.
Jack, you wrote that Wall Street's institutional investment managers are the most potent force in corporate America. And Leo Strine, by the way, Chief Justice of the Delaware Supreme Court, also warned about their unrivaled and largely unchecked power over the economy and corporate America. Why are Wall Street's institutional investment managers so important? What is the role they play?
When I came into this business in 1951, institutions owned about 3% of the shares of all American corporations. They were a very small voice. Today, financial institutions own 81% of all stocks out there. They control, through their holdings, corporate America. If you have one person who owns 80% of a company, believe me, the CEO will be coming in and saluting every morning because that person has control. Well, so does the mutual fund have control collectively. And they've never been able to get together a fact complicated by the reality that probably in very vaguely quantitative terms, about half of the assets of mutual funds are turned over a lot in sort of a speculative way, and the other half are good long-term investments.
So how might we shift this power to Main Street's advantage? How might Main Street savers and pension fund beneficiaries across the country hold Wall Street's institutional investment managers to be more accountable, either as direct clients of Wall Street through 401ks and IRAs and other savings products, or via their fiduciaries, the state pension funds, the police and the teachers' pension funds, etc.?
Well, eventually it's up to the clients. The clients have to speak. If the clients do not speak, these institutions pretty much don't care. They look at it as expensive. That's going to go on until we have the managers taking responsibility for the assets and for the governance of our corporations that we hold in our portfolios.
Let's talk about what you call pension fund capitalism as the far better alternative. This is about greater wealth creation, less crisis-prone capitalism, based upon better stewardship by Wall Street's investment managers, you wrote, to achieve long-term sustainable profit growth and thereby higher long-term sustainable investment returns, which is what pension funds need. Given the enormous size and thus clout over corporate America and thus capitalism that pension funds have today via their shareholdings, why haven't we seen this pension fund capitalism materialize?
Peter Drucker was a very farsighted and outstanding author and consultant and thinker about the American system. And long before the idea became possible, he wrote a book called Pension Fund Capitalism. And he made the point that the growth of large investors, large funds in large corporations would eventually give pension funds substantial voting power and voting and control over our corporations. He did not plan on the fact that pension funds would gradually diminish. Defined benefit plans would be replaced by defined contribution plans where the issues are very, very different.
Let's turn now to a different topic: ethics, standards, philosophy. You reminded us that no person can serve two masters. And regarding Wall Street, they can't both prioritize the best interests of their clients and their own profit generation. Meanwhile, father of economics, Adam Smith, made a similar point. But Wall Street would disagree and say, of course they put clients' interests first. Who's right?
The reality is that all these managers together earn the market's return. What else are they going to do? But they lose to the market by the amount of their costs. So when you say to someone that disagrees, well, if you really put your client's interests first, cut your costs, and then your client will get a larger share because cost comes right out of the return you earn for your shareholders. Cost is everything.
Jack, this is an industry with extremely lucrative margins, some of the highest indeed in the entire economy, with operating margins in the high 30s compared to around 8 to 10% for other sectors across the economy, which basically indicates the extent to which, by definition then, they do not put their clients' best interests first. They are in fact milking their clients.
This is a very important point. We've had 70 years, almost my whole business career, more than my whole business career, where the stock market has returned 11%. It is very difficult to look bad in that kind of a market. The challenge will, because everybody says, well, I made a lot of money for my clients. Well, don't you realize that over 70 years, that difference brought on by your cost is going to cost the client half of his total return, or whatever that number comes out to be?
But the active equity investment management firms would say, look, we're just selling what the customers want. Main Street savers and pension fund beneficiaries and their fiduciaries, the state and teachers and police pension funds, etc. This is what they ask for, which is active equity investment management, in other words, stock picking, not necessarily outperformance. In other words, they're kind of buying a lottery ticket, they're buying hope. What's wrong with that?
Well, the classic definition of marketing is find out what the clients want and give it to them. The problem with that, when you go from the general theory to Wall Street, is the customers usually want the wrong thing. The customer's instincts are often wrong. And the customer wants, when gold is doing well, they want gold. When energy is doing well, they want energy. And so on down the list. They are trend followers. They're looking at what their friends have done and jumping on that bandwagon. That does not work. It's definitely a negative investment strategy. It's going to cost you a lot of money. Finding the hot fund and hanging on to it, people buy it when it's high, get disappointed, and sell it when the returns are down. We should be leading the investors. We're professionals, and not let the investors lead us.
Harvard Business School professor of leadership Rakesh Khurana said that the difference between a profession versus a business is that the former creates value for society and the latter extracts value from society. But most people would say, well, what's wrong with being a business?
Well, it comes at the expense of the client. I mean, it's so easy to measure these things in the financial business or in the investment business. It doesn't seem very complicated to me. The investment advisor should put his client's interests first. I suggested at one point that firms that didn't do that be required to say to their clients, well, we put your interests second, but you're close. I don't think that's a good sales pitch.
Jack, you emphasize that one person can make a huge difference, and I'd suggest that in fact you're a great example of this. When you founded Vanguard in the 1970s, you were doing something extremely radical, and you've created a force of nature in the investment management world which has created so much value for so many Main Street savers and pension fund beneficiaries across the country. But it's easy to look back now and see what you've done, and it looks so easy. But at the time you were taking on the status quo of Wall Street and the investment management industry, and that can't have been easy at all. You were basically about to move a mountain. What on earth was that like?
Well, I think deep down I knew that would finally happen. But it's been one long struggle. We had years and years of bad times, years of failure, but you have to wait for the market to catch up. And then working and preaching through books, 560 speeches, all those things. So I think I have made a difference. Arthur Levitt certainly says so, former chairman of the SEC. And I look at myself as someone not overly bright, smart enough to do things, and maybe even above average, but just having a mission of making sure the client is served. This is a fundamental business principle. So in this business, it just seemed to suit me totally. I understand the math, which is very, very simple. And we certainly have, you're right, changed the world. It is a revolution.
If you had been building Vanguard on a short-term basis, would Vanguard even exist today?
Well, Vanguard almost didn't exist from the very beginning. So it took a little patience, not my strong point. It took a little perseverance, maybe my strong point. And it took a little contrarianism. The world may not like this today, but they'll like it tomorrow. And it all came together. You really cannot separate the structure and the strategy. And anyone who wants to duplicate our successful strategy is going to have to think long and hard about emulating our structure. I've told people that I picked the name Vanguard. One reason I picked it, because it means leader in a new trend. After 42 years, no one has yet followed by copying our structure.
Well, we are. It's critical to our mission to serve Main Street, to make capitalism and Wall Street, through its public equity investment management function, work more effectively for Main Street. So the structure that you insisted upon and pioneered when setting out Vanguard, where there would be no shareholders, and instead Vanguard would be owned by its customers, thereby ensuring that the company really could and would put its customers' best interests first and avoiding any conflict of interest in serving its customers. It's a shame and says a lot that no Wall Street firm has followed your example. So thank you for your incredible service and extraordinary pioneering example.
Well, it's been fun to have this conversation with you, Catherine, and I hope those who hear it will forgive my grammatical flummoxes and enjoy the substance of the message.
So hopefully by listening to these podcasts with these fierce rock star champions of Main Street, the picture will be forming in your mind that capitalism is yours, Main Street's for the taking. Number 1. Capitalism, like democracy, is a system of function that belongs, so to speak, to you, Main Street. It's supposed to work for you, not just for the boys on Wall Street who have essentially hijacked capitalism and are making out like bandits at Main Street's expense. So start to rethink of capitalism as yours and get argy-bargy with it, as East End Londoners might say. Oi, give me back my capitalism. And choose carefully who you let define capitalism for you. Stop listening to Wall Street's illiterate anti-capitalist definition of capitalism and Main Street's role in it as mere things, American workers, to be exploited to Wall Street's whopping benefit, and start instead to listen to the academics who have been banging their heads forever about this ridiculous Wall Street primacy model of warped, bonkers, train-wreck, caveman capitalism. Do you really want to let the economic thugs and anti-capitalists on Wall Street define your capitalism for you? I know that academics have gone out of fashion these days, but wouldn't you rather people who are a million times more thoughtful and better informed than Wall Street and Main Street champions and hardcore capitalists, which means they fiercely want capitalism to work for all, not just the few? Number 2, your voice, Main Street, carries weight. 55% of American households are shareholders, directly or indirectly, through your pensions, savings, 401ks, etc., or if you're a member of the police or teachers or state pension fund. And even if you're not in one of those categories, just being a taxpayer means that you're a shareholder by extension, and these fiduciaries, these state pension funds, are accountable to you because it will be you, taxpayers, who will be bailing out these underfunded state pension funds across the country. Remember, there is a severe pension fund underfunding crisis across the country because pension funds for years haven't bothered to do their job, which is to be effective stewards of Main Street's capital and enable companies to produce stronger long-term growth and thereby investment returns, and instead let Wall Street force this short-term focus down corporate America's necks, which is so harmful for long-term growth and therefore returns, and is the key driver of economic inequality. Number 3, as Jack Bogle said, Wall Street's investment managers are the most potent force in corporate America. And Warren Buffett agreed, saying, if you bring together the top 5 investors on an important issue, the world will change. When, by the way, he says investors here, he means the Wall Street investment managers and the fiduciaries, the pension funds, to Main Street, such as New York State, New York City pension funds, CalPERS, CalSTRS, Florida State, New Jersey State pension funds, etc., and all the various teachers and police pension funds. Number 4, Main Street has lots of power potentially within capitalism because of point 3 above, and because these Wall Street investment managers and the institutions that Jack mentioned earlier, the pension fund fiduciaries, they do not own that money. You do. They are just managing your money. It is these fiduciaries, these pension funds, who control Wall Street. They are the ones that are commissioning Wall Street and writing the blank checks with your money. Number 5, the real agency problem is between Wall Street and Main Street, whose money Wall Street is managing, not, as Wall Street loves to pretend, between shareholders and corporates. The agency problem is essentially where agents and managers act in their own interests, instead of the best interests of the owners of those assets, which they are managing. Here, Wall Street's investment managers are hijacking the voice of the real shareholders, Main Street savers, pension fund beneficiaries and investors. Number 6, there is no bigger threat to capitalism today in America than Wall Street. There is no bigger anti-capitalist group than Wall Street. They define themselves as anti-capitalists via their actions. They are the biggest rent seekers and wealth appropriators in the country, and they are the biggest welfare queens in the country too. How dreadfully, jolly embarrassing. Number 7. Wall Street and the public pension funds who power them are the key drivers of economic inequality by pushing a focus on short-term rationalization of strategy, cost-cutting in other words, down the throats of corporate America via the public equity investment machine. And rationalization is not a strategy, as Harvard Business School legend Michael Porter reminds us. The corporate CEOs then use globalization and automation and just-in-time scheduling and all the other tricks as tools of rationalization, in other words cost-cutting, i.e. squeezing workers. Remember, as Professor William Lasnik has pointed out, globalization and automation can either be used to help or to harm workers. They are just tools that CEOs use, and how they use those tools and to what end or to whose benefit is a choice that doesn't necessarily have to hurt the worker. But Wall Street enjoins corporate CEOs to use those tools to indeed harm workers and perpetually cut worker costs. And this results in weaker long-term sustainable corporate profit growth and thus weaker investment returns because you're cutting into productive assets. So economic inequality isn't just bad for American workers, it's disastrous for Main Street savers, investors and pension fund beneficiaries, and severely jeopardizes the very longevity of corporations and their sustainable long-term profit growth. The alternative is, instead of focusing on the middle lines, cost-cutting, companies must focus on the top line, investing in innovation via investing in workers as innovation enablers and long-run productivity growth drivers, as McKinsey calls it, to drive long-term organic sales growth via new products and services and markets. This approach results not only in higher long-term profit growth and thus investment returns, but it also results in sustainable and inclusive capitalism that works for Main Street, not just for Wall Street. The Wall Street model of capitalism is brain-dead caveman capitalism. Come on, anybody knows how to cut costs. It takes a lot more thought and skill to figure out how do you create new products and services and markets. The latter is smart, next-generation capitalism, and if state pension funds were pursuing this strategy, then they wouldn't be in the diabolical situation that they are today, where most of them are underfunded to such a scary degree. Number 8. Corporations are not the bad guys here. They're just as frustrated with these Wall Street handcuffs as anyone else. So there's huge potential support here. We just have to educate corporates, the blindingly obvious, that Wall Street are simply the hired help. It's not their money that they are managing, it's yours, Main Street's money, and that makes you the real shareholders. So corporations have to listen to you, you're the real shareholders, not bloody Wall Street. Number 9, and how do we do all of the above? We have to build a powerful, informed voice for you, Main Street. And that's what we're doing here, creating a public advocates for optimizing capitalism, which means optimizing and protecting Main Street's stake in capitalism. Join us, follow us on Twitter, sign our petitions. It's not glamorous, it's a bit boring, but then so is real life. So now at least you have a choice. To allow Wall Street's anti-capitalists and economic thugs to continue to hijack your voice and your economic power and force corporate America to continue to serve Wall Street's interests instead of Main Street's, or you can get behind the voice that we are shaping, drawn from the best academic thought and kick-ass rock star champions of Main Street on the planet. Number 10. By the way, I've talked in other podcasts and videos about potentially putting pressure on the state pension funds and teachers' funds and all the rest of it, but I've also talked about how that pathway appears blocked, at least for now, because that would make me a lobbyist. Yikes. So the best path forward for now is basically just to bypass them, make them irrelevant. They've really made themselves irrelevant because they've chosen to ignore this issue. CALP has actually said to me, the problem is we've actually made money out of economic inequality, which by the way is wrong because these short-term gains come at the expense of long-term returns and long-term growth. And ultimately pension funds have long-term obligations, as they're finding out now with this underfunding crisis. And it will be taxpayers who are going to be forced to bail them out. So we can bypass them and just go direct to the corporations on your behalf instead. Number 11. Having a voice that's supported and endorsed by thousands, or who knows more, of Americans across the country is going to have a profound effect. But on top of that, it's really important to also know precisely what to ask for and how to enforce that. So you need to have a specific set of requests, and that's where our economic inequality and innovation screens, for example, come in. You need to have a rock-solid business strategy, number-crunching, analytical skill set, in other words, that of a Wall Street investment managers, to be able to contradict the nonsense that Wall Street investment managers will throw up at us. So we'll have to be damn good and be able to kick that rot back. We'll also have academics shaping this voice, and hopefully some of the better quality global investment management firms as well. And then you have something that actually forces change. Change that the corporations themselves want to see. Number 12. Remember, Glinda doesn't exist, and she isn't going to rescue capitalism for you. You're going to have to rescue capitalism yourselves. Okay, over and out. That's quite enough for now. I think you've caught the gist. So finally, I just want to say thank you to our wonderful soprano Erica, whose gorgeous legato and upper register you have been listening to, as well as to our wonderful tenor and bass Stephen and Chris. Thank you so much for joining us. See you next time.
Ba, 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 ba.